research team, and today I've got the pleasure of hosting Carlos de Alba, who heads up our US basic materials research coverage that also includes US steel. So in terms of an agenda for today, we've got 30 minutes for the call where we'll cover off. I think we'll spend the first half of the call talking about the outlook for US steel, and we might spend the second half of the call talking about Steel Dynamics' aspirations to acquire BlueScope's North America business, given that's really topical. So if you'd like to ask a question, you can use the box on your screen and type a question in there, and then we'll do our best to incorporate it into the conversation. With that out of the way, Carlos, thanks very much for your time this evening. Maybe a good place to start is just on the broader demand outlook in the US for steel. Can you sort of comment on your views there for the outlook, and if you could perhaps nuance your response by some of the key end markets like construction and auto? Over to you, Carlos.
Yeah, sure. Happy to be here. Happy New Year, everyone. So look, we see a muted outlook in terms of demand for next year. We have two approaches to estimate demand for steel. One is a bottoms up, and the other is a top down. On the bottoms up, we are forecasting about 0.4% growth in 2026, and on the top down, around 1%. So fairly muted response or setup for the year. In terms of the bottoms up, we looked at what our different analysts or teams in the US are forecasting for autos, construction, machinery, oil and gas, and then we aggregate that to come up with an overall view for steel. And look, the two biggest ones are construction. And when we looked at two things here in construction. We looked at what our economists are forecasting for business fixed investment, which is the GDP forecast, the GDP bucket that measures the investment in plants, warehouses, and offices and whatnot. And they are forecasting that it will be down around 0.8%, basically flat in 2026. And then we also looked at the US non-residential construction that our construction and machinery team are forecasting, and they see a small decrease also of around 0.3% next year. We calibrate a little bit this forecast by assuming that the imports are coming down still in the first half of the year. So we assume that they're going to grow a little bit next year. The construction forecast that we end up using is a little bit more positive than these inputs. We're assuming that it's going to grow around 0.9% in 2026, just as the imports get reduced in the market. And then auto, which is the second largest bucket in terms of end markets for steel, our North American team is forecasting auto production to decrease 1.5% next year. So it's going to be the third consecutive year of declines. It will pick up next year, but for 2026 is the final decline of a number of years in retrieve. And so we are forecasting a similar pullback, a little bit less of a pullback, but around 1% decline in terms of auto production demand. When we looked at oil and services, we are forecasting around 2% reduction. And we are forecasting machinery, we're forecasting about a 3% improvement, 3.5% improvement year on year. So that is why when we aggregate the numbers, the growth that we see is only 0.4% on that bottoms-up approach. The top-down is a equation-driven number, and we look not only at the GDP forecast that our economists have penciled in, which is around 2% for this year, but also at the delta between last year GDP and this year forecast, and that is decelerating, and therefore that has a negative implication for the growth. But nonetheless, that is coming up to be around 1%, so a little bit better on the bottoms up. despite the deceleration in growth forecasted by our economists. And the good thing is for the mills is that despite the fact that demand is going to be soft, demand growth is going to be soft, imports have been coming down as a result of the increased tariffs that we saw, first to 25% across the board, and then to 50% starting in July. So when we calculate imports that were net imports that were around 20.1 million in 2024, we assume that we forecast that for the year 2025, they will end up being around 17, little bit more than 17 million tons. And then in 2026, we assume that they will be around 12.5 million tons. So that allows the mills to still gain market share, if you will, capture the void, the decrease in imports, and to supply directly to customers, even though demand is not growing as much. So they have the ability to expand shipments a little bit more than demand, just as they substitute imports. So with that set up, we really think that if we are right, prices are don't really offer a bullish risk reward from here, and we're hearing mixed signals and mixed messages from our folks in the industry that we typically talk to. Some of them are more optimistic than others, but prices could potentially go to $1,000 for a hot rolled coil. That is per short ton, maybe 1,050. But in the way we looked at it, we can also go to around 800, right, in the coming months. There is not real consensus on people that we talk to, and so our forecast is for prices to remain, yes, elevated in a historical context, but for HRC, our new forecast for 2026 is an average of basically $864. That is slightly higher than the average of 840 in 2025, and then they will remain around 825 in 2027. So more or less steady at a historically elevated number. For rebar, for those that are interested, we are forecasting 870 in 2026, up from 835 in 2025, and then dropping to around 810 in 2027. So still numbers that are elevated from a historical perspective that allow most mills to really post strong margins and good numbers.
Okay, that's a really helpful run through, Carlos. Maybe I'll just ask a follow-up question there. So you sort of talked about a soft demand environment. You've talked about imports coming down due to tariffs. You've talked about domestic mills taking share on lower imports. So it seems to me the key thing here that's keeping prices going up slightly this year is the tariffs. So my question is around tariffs. Do you expect them to be maintained, loosened, tightened? What's the outlook for tariffs in 2026, given that's so key to the, the dynamic here?
Yeah, absolutely. I mean, import tariffs are supporting pricing. We are not really forecasting any changes. We highlight, obviously, that the USMCA negotiations in the middle of the year are going to be probably the most follow theme in terms of potential changes. We never really know with the current administration. It could change on the fly. You just get a tweet, well, not tweet, but through social text, and things are changing. But our view is that they remain elevated at 50%. Potentially, there is going to be a deal done with Mexico, arguably less likely with Canada. But it's difficult to not have a core economic area or zone where things could flow more easily with less friction, tariff friction. That said, Mexico really is a net importer of steel versus the U.S. overall, certainly in flats. And so we don't think that Mexico really matters that much for the U.S. But the administration likes to be tough, at least early on in the negotiations. So presumably at the end, maybe Mexico gets a concession, less likely that Canada does. Canada obviously is a bigger producer and net exporter of steel into the U.S. And the relationship between the two countries and governments hasn't been the best. And the one with Mexico, I would say that is much better, but at least has not been as generate as a lot of tension or friction as the one with Canada. But yeah, our view is that the status quo continues, and it continues in the coming years as well. The reality is we've gone through different administrations, Democrats, Republicans, and the steel sector continues to be protected. It's going to be fairly difficult to roll back those tariffs, particularly to zero. Again, there might be a few instances where there are some exceptions here and there, but for the most part, certainly during Trump, we think that the import tariffs are going to remain elevated.
Okay, got it. I might just ask one more question on the outlook for steel before sort of moving discussion on to the Steel Dynamics bid for BlueScope. So just sort of the final question I've had, you've obviously talked about a little bit of steel price growth this year, but obviously the input costs are really important for the spread. So can you maybe comment on your outlook for things like scrap prices and what that means, and any other sort of key inputs and what that means for steel spreads in 2026?
Yeah, so look, the outlook for global prices will be dictated on what happens to primarily, I would say, for China net exports, which we think that Rachel Chang, our China analyst, believes that they're gonna come down a little bit, but not significantly. And the issue is that as CBAM kicks in Europe, there might be some imports that used to go there that now are gonna be without a home and trying to fight in the global market for those that remain still open or more open than North America and Europe. So the competition is going to be intense. Prices probably, global prices probably tend to be on the trade, like they tend to come down. So even if steel prices in the U.S. come down from current levels, the spreads are not necessarily going to drop too much. They might drop a little bit, but not significantly. And at current levels, again, I'm hearing mixed messages. Some people say that at current spread for hot coal, for example, they could import profitably, and some are starting to test the markets and try to see what happens. But others are really afraid of engaging in any imports, so just because they don't know, and also the foreign mills don't know if the rules of the game are going to change in the middle of the discussions or when the vessel has been shipped, and who's going to face the higher potential tariffs or a new anti-dumping study and potential tariffs there. So there is a lot of uncertainty on the policy front, on the tariff front, and that is keeping both importers here in the U.S., traders and service centers that typically import, and foreign mills much more cautious than they otherwise would be. And so the spreads, I don't envision a significant change, and they are profitable, or certain products are already profitable at current levels, but I think we probably will have to see an even larger spread to re-incentivize a bigger, more meaningful wave of imports into the country.
Okay, got it. That's really helpful, Carlos. So let's move the conversation on to the bid for BlueScope. So as a quick recap, Steel Dynamics, which Carlos covers, has formed a consortium with SGH, and they've made a bid for BlueScope at $30 Australian per share, which BlueScope has rejected. So maybe an opening question, Carlos, is when you first saw this deal, what were your sort of initial impressions? Do you think it makes strategic sense for Steel Dynamics to have an interest in BlueScope's North American assets?
Well, first, I was glad that it was not during right the week of the holiday, but nonetheless, they didn't give us many days to get back and adjust in the office. But yeah, look, on a serious note, yeah, it makes sense, right? Because it is a electrical furnace, flat steel. Steel Dynamics has a little bit more exposure to flats than they do to longs. The company, the North American operations of Blue Steel are backward integrated at least to some extent into scrap, and they also have a significant exposure to coating and some fabrication that goes into construction and market. So, strategically, and the end market exposure and the type of operations and the backward integration into scrap, all of that fits Steel Dynamics business model. So that made sense to us. And then obviously we knew that they had been interested in the past. We didn't know that it had been like 4 times. This was the 4th attempt to get a deal done. But yeah, I mean, obviously that tells you that they really like this combination, and that they keep coming back. I don't know why the offer hasn't really improved dramatically or at all. And we have not been able to talk to Steel Dynamics. They're already in the quiet period. They will be reporting in a couple of weeks, so we couldn't talk to them. But definitely, from a strategic fit, I think it makes sense.
Okay, got it. And just, I guess, out of curiosity, the North Star asset is the jewel in the BlueScope crown, and most of the people on this call have followed BlueScope for some time and are really on top of the North Star asset, and it's pitched to us as a T1 asset. My question to you is, had you ever heard of the North Star mill? Do you know much about it? Does it get talked about with people in the industry or corporates? We've also always known it as a sort of T1 asset. Just wondering if it's a well-known asset in U.S. steelmaking.
Yeah, well, look, I definitely have spoken more about this asset in the last week than in the last 2 years for obvious reasons. But yeah, look, the feedback that we're getting from industry folks, service centers and traders that buy directly from them, is that it's a good asset. I mean, most people speak highly of the quality of the products and the service that they provide. The feedback from this type of folks is that they wouldn't like to see that independent supplier gone. But particularly, they think that the low gauge sheet they are very good at it. And they highlighted that this is an area that also Steel Dynamics competes in, but they just saw at least one person thinks that the quality of North Star is better than what the Steel Dynamics has been delivering, and maybe this is one of the reasons that of the interest. Clearly, the trend in the steel sector is for light weighting, so thinner gauges are going to be more relevant, or have become more relevant. I've heard that maybe on the quoting side, they sometimes struggle. At least that's the feedback I got from another service center on the quoting line. Sometimes they struggled and maybe not as profitable. They're not as profitable as Steel Dynamics might be, and that could be potentially an area of opportunities to enhance the returns and the margins in the overall business.
Okay, got it. So you just published a note out on Steel Dynamics only sort of 30 minutes ago. I've had a quick read and just wanted to ask a few questions from that note. So I know you've done a little bit of work trying to back out the valuation for the implied valuation for BlueScope's North American assets. So can you maybe talk us through what you think the implied valuation is and how that compares to some of the other listed players?
Yeah, sure. So look, what we did, trying to understand the valuation for the BlueScope North American assets, is we looked at your forecast for the business, and then we assume that within the $30 offer, more or less the split is going to remain, or the value assigned to the North American asset is the $24 Aussie that in a prior attempt, Steel Dynamics suggested that was the valuation for those assets. And so assuming there is not debt not net debt or any other significant liabilities, which we don't really know, but it makes sense. The total debt, net debt for BlueScope is not significant. That would give us an implied equity and an enterprise value of around 7.1 billion approximately. So divided that by the 2026 EBITDA for those assets would suggest a multiple, a hypothetical valuation of close to 9.8 times that 2026, and which obviously is much more closer, in fact, above the multiples at which Nucor, Steel Dynamics, and CMC are trading on our 2026 estimates, right? So that's the way we looked at it. I mean, we really don't know exactly how they're going to split the value, but we took that 24 Aussie dollar per share reference valuation and apply it. So that would be sort of a ballpark of how much they would be willing to pay for those assets.
Okay. And then how do we think about synergies and what would that do to the acquisition multiple?
Yeah, so what we did there is we looked at the SG&A and the cash cost for 2026 for those assets, and we assume that they will be able to generate around 5% cost reduction on cash costs, and around 25% decline in SG&A expenses. Look, obviously, we could have run some sensitivities around these numbers, and the companies have not commented on this. And as I mentioned, Steel Dynamics is not really talking. SG&A, I think, is probably more easier to achieve, and potentially could be even larger. Costs, could be a little bit less, could be a little bit more, right? And so when we factor those in, we calculated a potential annual synergies of around $260 million. So when you add that to the 720 million EBITDA on 2026 for those North American assets, we get a little bit less than $1 billion. And so the hypothetical post-synergy EV to EBITDA multiple will drop to approximately 7.2 times.
Okay, got it. So with the synergies, the multiple comes right down to be sort of in line with some of the listed peers. So I've got a couple of questions here from the audience, so I might just sort of work them into the conversation now. I'm not sure if you've got metrics, prior deal metrics in the steel industry at hand, but one of the questions he's asking, how these multiples compare to prior deals. I'm not sure if you've got that information at hand.
Yeah, it's more or less in line. I mean, for U.S. Steel, Nippon Pay is something around 8.5 times, and the implicit valuation for Big River was a little bit higher than that, around 9 times, pre-synergies. So it seems to be relatively consistent with those transactions. When U.S. Steel bought the Big River, it was a little bit more complicated to come out or calculate a precise multiple because they did it in stages, but it was also around 8.5 times. So it seems to be in the ballpark of some recent transactions.
Okay, got it. And then the next question we had from the audience is just around other potential bidders. So are there any restrictions on other players like Nucor buying North Star, or does it make sense for any other players to bid for these assets?
Well, look, I think the fact that it is electric arc furnace makes obviously Nucor a possibly interested candidate. But maybe a big difference is that relative to Steel Dynamics is that Nucor is in the middle of a CapEx cycle, or at least halfway through a CapEx cycle, and they are building in West Virginia sheet mill, 3 million tons. So I don't know if they have an appetite to add another at this stage, another sheet, basically same size more or less, asset, just right now. CMC is really more long. It's only long steel. So even though it is an electrical furnace, I doubt that they will be interested. It doesn't seem as obvious. And plus, they just completed a couple of transactions on precast concrete that really stretch the balance sheet. I don't think they will pull the trigger right now. Nippon, you still probably unlikely, and then Cleveland-Cliffs wouldn't be able to do it with the balance sheet right now.
Okay, continuing on the lines of balance sheet, there's a question here from the audience just around Steel Dynamics balance sheet. And I know you've talked about it in the note that they're going to have to gear up, I think, from memory to 2 times. But correct me if I'm wrong there. But the question from the audience is how Steel Dynamics shareholders would feel about gearing up the balance sheet for this acquisition. Do you think they would be supportive? So maybe if you could talk to that and how much more capacity they've got, because obviously BlueScope has said no to the most recent bid, so they'll need to come in with a higher bid. So just trying to understand how much capacity there is to leverage up the balance sheet.
Yeah. Well, look, we saw how Steel Dynamics shares reacted to the offer. They came down for 2 or 3 days. They underperformed peers. So yeah, the initial reaction is not that favorable, and it has to do more than concerns on the balance sheet with the expectations that as they were came out of their capex cycle, their free cash flow obviously is improving, and that would put the company in a position to return more cash to shareholders. This is a company that typically does that, and when the capex cycle comes to an end, they expand, at least temporarily, those cash returns. So there was an expectation on that, and obviously that not necessarily would happen for a period of time if this acquisition would come back and get done. But Steel Dynamics is a very good company. They generate a lot of cash, and so when we in our current estimates, we assume that the net debt to EBITDA by year end 2026 will go down to around 0.4 times, and then that is on $2 million of net debt at the end of this year. So if the acquisition happened at the 7.1 million that we discussed, that would bring the total net debt to around 9 billion. And when we factor in the EBITDA that I mentioned of around $1 billion, a little bit less than $1 billion post synergies, then the overall net debt to EBITDA post transaction, we estimate it will come to around 2 times, as you pointed out. Then looking forward or looking out to 2027 and 2028, assuming that the deal probably takes most of 2026 to close, hypothetically speaking. Then we looked at the cash that Steel Dynamics would generate in our numbers, in our current numbers in those 2 years. We looked at cash from operations minus capex, minus dividends, and minus current debt repayments. And we estimate the money that will be available to pay down debt of this related to the acquisition, this hypothetical acquisition, would be 1.8 billion in 2027 and around 1.9 billion in 2028. And then when we add around $1 billion on estimated free cash flow for the assets that they will be acquiring, that means that by the end of 2027, net debt to EBITDA would have fallen potentially or hypothetically to 1.3 times, down from 2 times, and then to less than 1 times, 0.8 times by the end of 2028. So it wouldn't take many years for them to really get back their balance sheet back in shape, just because they generate a lot of cash.
Okay, got it. Conscious of your time, Carlos, can I sneak one more question in from the audience?
Yeah.
We'll make that a final one.
Absolutely.
So last question is just around new capacity in the US. Can you talk about timelines for new steel producing capacity?
Sure. I mean, it's not secret that really since 2018, when Section 32 first came about, there has been a lot of capacity that has come into the market. So in the note that we publish, we have a list there. There has been around 16 million tons of capacity through the end of 2025 that have been installed. Not everything has been fully ramped. And then there is another 10 million tons of either capacity in progress or planned that may come between now and 2029, 2030. Specifically for the 2026, 2025, 2026, 2027, we see around 8 million tons of new sheet capacity. Basically, three big projects. Two of them are basically done. One is Big River 2. The other is the Calvert ArcelorMittal asset. And then the one to come is the 3 million tons that I mentioned of Nucor West Virginia mill. And then so those 8 million tons are around 15% of the 50 million share market that we estimate for sheet. And then when you look at rebar, it's around 2 million tons of rebar coming, 2.1 million tons. That is as a percentage of total market, which is around 9 million tons. Of the greater is around 25%, a little bit more than 25%.
Okay, great. We are.
The good thing, the only thing, Joe, sorry, is that because imports have been coming down, right? That is opened up space, and it has created a buffer. It has acted as a buffer to incorporate or absorb this capacity. Also, most of the new supply is being brought in by incumbents, which have an incentive to be disciplined on how they ramp up the capacity, and so that they don't oversupply the market as much as otherwise would be the case.
Okay, got it. That's really clear, Carlos. Just want to take this opportunity to say thanks very much for your time this evening, Carlos. That was a really good run through. We're keen to keep in touch, particularly as this whole Steel Dynamics bid for BlueScope evolves. Maybe we can do a follow-up call later on down the track. But we really do appreciate your time this evening.
Yeah, fantastic. Happy to be here. All the best this year.
Okay, great. Thanks, everyone.
Okay, cheers. Bye-bye.